The Union Budget 2026 has introduced significant changes to how share buybacks are taxed in India, reversing the system implemented in October 2024. Notably, Finance Minister Nirmala Sitharaman clarified that the revised framework aims to benefit small and retail investors, while curbing the use of buybacks by promoters as a tax-saving alternative to dividends. Well, under the new tax structure, buybacks will again be taxed under the capital gains framework, moving away from the previous dividend-based taxation. Well, what is a share buyback? Let us break it down. A share buyback occurs when a company buys its own shares from existing shareholders and then cancels those shares. And this reduces the total number of shares in circulation, which can improve earnings per share, that is EPS, and increase the promoter stake in the company. Buybacks are also used as a way to return excess cash to shareholders. Well, how buybacks were taxed previously? Notably, under the system introduced in October 2024, buybacks were taxed as dividend income at individual income tax slab rates, and which could go up to 30%. And this treatment ignored the purchase price of the shares, meaning investors were taxed on the entire buyback amount, even if they made no real profit. In an attempt to address this, investors were allowed to claim a capital loss on the extinguished shares. However, this created complications for retail investors who didn't have other capital gains to offset all these losses, resulting in taxes on paper gains that didn't even exist. Well, another question arises that why the old system was problematic for retail investors. Notably, the old system caused hardship for small investors who ended up paying taxes on gains that they never actually realized. The Income Tax Department acknowledged that buybacks should be taxed as capital transactions, not dividends, and that the previous approach added unnecessary complexity for retail investors. Now, let us shed light on the changes under Budget 2026, as the new system proposed in Budget 2026 reverts buybacks to the capital gains framework. Shareholders will now pay tax only on the actual gain calculated as the difference between the buyback price and the cost of acquisition. And for non-promoter shareholders, including retail and minority investors, the tax rates will follow standard capital gains rules. And long-term capital gains, that is shares held for over 12 months, will be taxed at 12.5%, while short-term gains, that is shares held for less than 12 months, will be taxed at 20% for listed shares, and unlisted shares will be taxed at the applicable income slab rate. Now, let us understand it with the practical example of the new tax system. Let's say an investor bought shares at Rs 700 and tendered them in a buyback at Rs 1000. The 300 gain will be taxed as capital gains, and if the shares were held for more than 12 months, the gain will be taxed at 12.5%. And if held for less than 12 months, it will be taxed at 20%. And if the buyback price is lower than the original purchase price, the resulting loss can be set off against other capital gains or carried forward for up to 8 years. Well, what is the special tax treatment for promoters? While the changes are favorable for small shareholders, promoters will face higher taxes. Promoters will first pay capital gains tax and then an additional buyback levy, pushing the effective tax rate to 22% for corporate promoters and 30% for individual or overseas promoters. And this discourages promoters from using buybacks as a tax advantage tool over dividends. Well, what's the bigger picture that we can look forward? In sum, Budget 2026 simplifies buyback taxation, aligns it with capital gains principles, and benefits small investors by providing clearer tax outcomes. And the additional tax burden on promoters ensures a more balanced approach to shareholder payouts, closing loopholes, and offering a more equitable system for all the investors. That's all for now. Stay tuned to the Savera for more updates. Do like, comment, and subscribe to the channel.